Welcome and get ready to dive into the thrilling world of investments, where numbers dance, money talks, and the unexpected always keeps us on our toes. Palantir Technologies stock has been hammered in the last few weeks. The company reported slightly better than expected second quarter earnings on August 7th, and its management actually gave a more bullish forecast compared to analysts' expectations. Nevertheless, the market just had a very bearish sentiment, and the stock price fell more than 20% in a month. Is Palantir Technologies' Q2 earnings indicative of a stock worth betting on? We will analyze its earning numbers in this video, and share with you a discounted cash flow valuation which shows that Palantir's fair stock value is somewhere around $26 per share. This implies its current stock is trading at a 44% discount, so there are great opportunities for Palantir stock. Let's first recap Palantir's latest earnings. Total revenue came at $533 million, while the company's adjusted earnings per share stood at 5 cents, aligning with market expectations. Net income was $28 million, compared to a net loss of $179 million in the year-ago quarter. Palantir has two major revenue streams, commercial and government. The financial breakdown reveals impressive results in each of their revenue segments. Of the $533 million total revenue, Palantir booked $232 million in commercial segment and $302 million in government segment. These numbers represent a 10% growth in the commercial sector and 15% growth in the government sector. Looking ahead, Palantir's projections for the upcoming quarter are equally promising. For the September quarter, the company anticipates revenues between $553 million and $557 million, slightly higher than the consensus of $553 million. Adjusted income from operations is also projected to remain strong, with guidance ranging from $135 million to $139 million, surpassing Wall Street's forecast of $131 million. Perhaps more importantly, on a GAAP basis, Palantir reported an EPS of 1 cent per share. This number looks small, but it really has significant implications to Palantir stock. It marks the third consecutive quarters of GAAP profitability. If Palantir reports another quarter of GAAP profitability, which the company believes they will achieve by September, PLTR is eligible for inclusion in the S&P 500 index. If that happens, there is huge upside for the stock, as many ETFs tracking the S&P 500 index will need to hold PLTR stock in their portfolio. As a result, Palantir could attract a substantial inflow of investments, indirectly bolstering its share price. Palantir stock initially reacted favorably after the earnings release, but in the following weeks, its price dropped more than 20%. Now it is trading around $14 per share. It is hard to pinpoint what is driving the sell-off, but if you look at the broader market, it definitely feels risk-off sentiment is winning. The S&P 500 index declined more than 4% in August, while Nasdaq 100 index shed more than 7%. In the news, Fed officials see upside risks to inflation possibly leading to more rate hikes, and the U.S. 10-year yield is creeping back to the highest point in a decade at 4.25%. With the market pulled back in the last few weeks, it presents a good opportunity to consider Palantir Technologies for the long term. We are going to show you an article that uses the two-stage DCF model to determine accurate intrinsic value for Palantir stock. If you are unfamiliar with discounting cash flows, don't worry, you can fast forward to the 5-minute mark for conclusion of the analysis. The two-stage DCF model, as the name suggests, involves dissecting the company's growth trajectory into two distinct phases. The initial phase encompasses a period of aggressive growth, followed by a subsequent phase of more stable growth leading into the terminal value. Key assumptions underpinning the analysis include the expectation that companies with declining free cash flows will experience a deceleration in their rate of decline, while entities with growing free cash flows will observe a moderation in their growth rate over time. Additionally, the concept of time value of money accounts for the idea that a dollar today holds greater value than a dollar in the future due to factors like inflation. Skipping over the technical intricacies, the analysis starts with a 10-year free cash flow projection, spanning from 2024 to 2033. Calculations involve growth rates, leveraged free cash flow, their present values, and a discount rate of 7.1%. This yields the present value of a 10-year cash flow to $17 billion for Palantir. The next step involves determining the terminal value, which encapsulates cash flows extending beyond the initial 10-year period. A formulaic approach calculates the terminal value, providing insight into the company's future financial prospects. The present value of the terminal value emerges as $41 billion. When summing the two parts, we have the total equity value, which stands at a substantial $57 billion. This figure means that the market capitalization should ideally align with this value. If we divide this $57 billion by the number of Palantir shares outstanding, we will then obtain the fair share price of $26.70 per share. Without saying, there are a lot of assumptions that go into the calculation, so we should take it with a grain of salt. But at least this $26.70 intrinsic value calculated using DCF shows Palantir being discounted at current level. Discounted cash flow is one metric investors can use to value a company. There are many other metrics out there, and by those standards, Palantir stock is still not cheap in valuation. Palantir's price-to-earnings ratio is currently around 68 on a forward basis. While this number has come down compared to a year ago, it is still very high, indicating investors are paying a substantial premium for comparatively moderate earnings. The price-to-sales ratio tells a similar story. 15.02 is much higher than the sector average, which comes at 2.72. The high valuations suggest Palantir needs to execute flawlessly in the upcoming quarters to grow its business. Ideally, a lower figure would offer investors a more palatable perspective. More than 100 business customers are already using Palantir's AI platform, known as AIP, so it's possible that adoption and usage of the platform are still just starting to scale. In the Q2 letter to shareholders, Palantir CEO Alex Karp also says that his company is in talks with 300 other enterprises that are potentially interested in adopting the platform. If Palantir's revenue continues to grow double digits in the next few years, both PE and PS ratios should come down, which will help the valuation. I personally think Palantir has a lot of opportunities to grow their business with the AI tailwind. On top of that, the current price is a pullback from recent highs, so I would invest in a small position for the long term. More importantly, what do you think of Palantir at $14 a share? Do you think it is going to hit the single digit in the upcoming weeks? Leave your comments and thoughts below. As you weigh your investment decisions, consider subscribing to our channel for more in-depth analyses and insights into the dynamic world of finance. Hit the subscribe button now and stay tuned for more valuable updates. See you in the next video.